So this video is about calculating real interest rates. And when we talk about real interest rates, typically we're talking about the context of country level interest rates. So for example, we're talking about the United States. And one way to look at interest rates is to look at government bonds. In the United States, we call those treasuries. And one thing about government bonds, like treasuries, is that the yield on those treasuries is nominal. And what nominal means is that it's some sort of mixture of an interest rate that we might call related to inflation, and some other component that we might call the real rate. Because when an investor thinks about buying a treasury bond or any government bond, they're less worried about risk. If it's a country like the United States, in other countries there may be an element of risk involved, but they're generally less worried about that component. And what they're concerned about is making sure that the yield that they get is at least enough to offset inflation. So if inflation is expected to be, and I say expected to be, over the next year, say 5%, then what you'll typically see in normal periods is that the yield on a U.S. government security on an annualized basis is at least 5%. Because the investor, if they don't receive at least 5% on this government bond, then they're sort of effectively losing money because of their purchasing power being eroded. So they at least get that sort of inflation amount. But if you find that the yield on the treasury is not just the expectation of inflation, but say something higher, then the difference between that inflation expectations and the actual yield observed is what's called the real rate. And that's just sort of some fundamental rate of interest that investors expect over and above the rate of inflation for basically lending out their money. And as I said, there are different government bonds out there. Each country typically offers its own sovereign bonds. And interest rates differ on those government securities, as do consumer prices in those different countries. Japan, inflation tends to be quite low. The US right now, inflation is actually quite high, higher than what you see here, but that may change, but on par with what you typically see in Australia. And so by taking these interest rates that you see on these government securities, you can in fact sort of deflate them by expectations of inflation. And in here, we're using forecasted consumer price growth over 1 year, over the next year to do that. But you can deflate those nominal interest rates by these consumer price index rates to get an expectation of a real rate of interest for each country. That's called the implied real rate of interest for a country. And the way that deflation occurs, mathematically speaking, is we take 1 plus the nominal interest rate, and that's that interest rate that you see here on the left for each country. And then we divide that by 1 plus the expected inflation rate. And that's what you see here. We're using expected growth in consumer prices, which is really inflation when it comes down to it, as our proxy for that. And then we subtract 1 and then multiply 100 to get it into a percentage form. So for example, if we were going to calculate the implied real interest rate for Australia, we would take the interest rate for Australia and divide it by 1 plus the consumer price index for Australia. Subtract 1, multiply all that by 100, And the implied real rate for Australia is 3.15%. We can do this. It's fairly simple because these are both 1 year expectations. We don't even need to de-annualize or annualize. It's all kind of been done for us here. For Japan, we just pick Japan's numbers. Its nominal interest rate, which tends to be low, divided by its consumer price index growth, which is basically nil, to get a real rate of interest for that country of 1.75%. Then finally, we can do the same thing for the United States. This nominal yield of 4.65% divided by a consumer price index growth of 3.6%, and we get real yield of 1.01%. That's it mathematically. I would point out one thing that's happening right now at the time of this recording is that the United States and even other countries, their inflation rate, the consumer price growth is 7 or even higher in terms of percentage. And yet the government bond yields, in part by central bank action, are low. 1 year government bond yields 2%, maybe, if that. And so in the United States, you actually have right now a negative real yield. But this is kind of an unusual situation, and it's really just kind of the effect of the pandemic and aftermath of it. So I guess a more thorough explanation would be that this is kind of a snapshot and point in time. And what's happened is that U.S. central bank policy has been to keep interest rates low during and after the pandemic. And rather suddenly what's happened is that inflation has really risen up quickly to 7%. And you could say that the central bank is kind of slow behind the curve in terms of responding to that. And that's why temporarily you're seeing these negative real rates happen. But the central bank at this point is not just doing nothing. It's now reacting. It's seeing this 7% growth here in consumer prices. And as a consequence, you're seeing interest rates rise. The central bank trying to push interest rates up through these quarter points or 50 basis points or potentially even 75 basis points each month or each quarter to try and push interest rates up. And so eventually the nominal yield on these government bonds as a consequence will start to rise, and inflation may, who knows, but may settle or may actually reduce. And so then you'll see eventually a balancing out to a real rate of return that's maybe not negative, that's maybe positive or something more consistent with what happens over a longer term horizon.